We're going to do CAS Talks a slightly different way this week. CAS Academic has managed to not only debunk one of the great myths of modern finance, but find the proof. He can show you why dollar cost averaging doesn't work. Here he is, Simon Hayley.
Okay, thank you very much. What I'd like to do this morning is just run you through just the briefest details of the paper I've done on dollar cost averaging. Full details are in the paper that's on the website. What I want to do in just a few minutes now is just give you the intuition behind some of its key results. So, dollar cost averaging. Firstly, what is it? It's a very, very popular investment strategy. If you look online or in popular investment books, you'll see it very widely recommended. The reason it's recommended is because it looks like it is a very good way of boosting investment returns. What I'd like to argue is it isn't, and I'd like to show you why it isn't. So, the dollar cost averaging strategy. The strategy is, if you've got a certain amount to invest, don't invest it all at once. What you should do instead is invest it regularly, once every month, once every week, and this is the key point, in equal cash amounts each period. And the reason why dollar cost averaging is recommended is that if you do this, you will always end up buying at a lower average cost than the average market price over that period. Here's an example. The dollar cost averaging strategy is investing $60 each period, just over 3 periods. Over this period, we've got the price of these shares fluctuating massively. This is just a particular example I've chosen to make the arithmetic easy. Trust me, it doesn't matter what numbers I choose. So, first period, we're investing $60, we buy 20 shares. The second period, the price falls dramatically to $1. And the key is that the dollar cost averaging strategy will automatically buy a lot more shares that period just because they're cheaper. It's investing the same cash amount, $60, but that period it will buy 60 shares. Third period, prices are up again a little bit, but the key point is what happens at the end. The end of this period, we've invested $180 as we knew we would, and we've bought 110 shares. The key is the average share price over this period was $2. The average cost that we've bought our shares at using the dollar cost averaging strategy is we've bought 110 shares at $180, that's $1.64 per share. It's a much lower average price than the average market price over that period. Now that is the selling point for dollar cost averaging. Investors look at this argument and see it seems utterly obvious, a complete no-brainer, that if you buy at a lower average cost, you must make higher expected returns. To be clear, you don't know what price you're going to sell these shares at, but whatever price that is, would you rather buy at $2 per share or buy at $1.64? It seems an utter no-brainer. Now, academics have been arguing for some time that when they crunch the numbers, they find actually it's an inefficient strategy. It doesn't boost returns. In fact, not only does it not boost returns, it's actually inefficient in the sense of it doesn't give you as good a risk-return trade-off as you could get with other strategies. But what seems to have happened is investors out there in the investing community appear to have taken no notice at all of what academics are saying, and I think the reason for this is it seems so utterly obvious to them. When they see these numbers, they'd rather buy at a lower average cost. It must, they think, increase their average returns. So what I'd like to show is why that isn't true, why this seemingly obvious point is actually very misleading. So what I need to do for this is actually think more about what are we really comparing. So dollar cost averaging, we are comparing the average cost achieved by dollar cost averaging with the average share price. What we need to do is work out what the comparison strategy is. When we're making that comparison of average costs, we're really comparing dollar cost averaging with some other strategy. What I want to do is narrow down what exactly is that strategy. And what I'd like to convince you of is that when we make that comparison, we're comparing dollar cost averaging with a strategy that invests in an equal number of shares each period. It must do that. That's how it buys at exactly the market average price. Secondly, it must invest the same total amount as dollar cost averaging. If we don't have these two strategies investing the same amount, we've got no meaningful comparison at all. So when we're making this comparison of dollar cost averaging's average cost with the average market price, we are comparing dollar cost averaging with a strategy that invests equal numbers of shares each period and invests the same amount. I need you to be convinced of that because that turns out to be absolutely crucial. Is that okay? Good. So let's see in more detail what this means. Let's rewind back to the first period. We're going to run a dollar cost averaging strategy, and then next to it, we're going to run this comparison strategy. Let's call it ESA, equal share amounts bought each period. So, period 1, the price is $3. We know exactly what our dollar cost averaging strategy is going to do in advance because it doesn't depend on the price. We're trying to replicate that $180 by buying equal numbers of shares. What number of shares should we buy the first period? I'd argue it would be reasonable to buy 20 shares. That way we spend $60 this first period. If prices stay around this level, then we've achieved our objective and spent exactly the same amount. But what actually happens? Let's show these future prices. Prices fall dramatically. Dollar cost averaging naturally invests exactly $180. Our strategy, we are committed to buying 20 shares every period. And because we can't increase the number of shares each period when their price falls, we're going to end up spending a lot less than we'd hoped. We invest only $120. So this would be a perfectly sensible strategy, but this is not the comparison we're making with dollar cost averaging. The comparison we're making is instead with this other strategy here. Let's call it ESA2. If we'd invested 30 shares, bought 30 shares every period, then we would have spent exactly the $180, the same as the dollar cost averaging strategy. This is the strategy we're comparing with dollar cost averaging. Now, the difference between these two may seem trivial, just a matter of scale, but that makes all the difference. So if we bought 30 shares a period, we would have made the correct comparison. How would we have known in the first period that we had to invest by buying 30 shares each period? And the answer is we couldn't, unless we knew what these future share prices were going to be. It's only because this strategy is based on the foreknowledge that prices are going to fall that it knows it must buy more shares each period. So we are comparing dollar cost averaging with this strategy, which is based on perfect foreknowledge of future share prices. That's bad news. The worst news is, what is this comparison strategy doing with this information? What it's doing is, in this case, it knows that prices are going to fall, and in response to that knowledge, it's investing more than it otherwise would. Now, that of course is a recipe for losing money, but that's the only way it can guarantee it spends exactly the same amount. If it knows prices are going to fall, it must buy more than you would have expected. If it knows prices are going to rise, it will buy less. So, here's the punchline. In making a simple comparison of the average cost achieved by dollar cost averaging with the average share price, we are comparing dollar cost averaging with this strategy, which assumes perfect foreknowledge of future share prices and uses that knowledge to invest stupidly. So that's the comparison we're making. It's not surprising that dollar cost averaging looks pretty good on that comparison, but of course it's not a remotely meaningful comparison. So that is why, although it seems like a complete no-brainer, that's why dollar cost averaging doesn't actually increase returns, because the comparison we're making is based on a completely misleading strategy. So this is the conclusion. Comparing dollar cost averaging's average cost with the average share price is what sells dollar cost averaging to investors. It seems like a completely obvious comparison to make, and it seems obvious that means dollar cost averaging will boost returns. When we unpick that, we're actually comparing it with a strategy that invests the same total amount, buying equal numbers of shares each period. Doesn't seem too unreasonable, but when we look at that strategy really is assuming complete foreknowledge about future share prices, and it's using that future knowledge to invest stupidly. That is why dollar cost averaging doesn't work. So, in itself, this would be quite a pleasing puzzle if it came in a Christmas cracker. Quite a pleasing thing to wrap your head around. Actually, though, it's very important, because so many investors around the world are using dollar cost averaging. Many investors are investing on this inefficient strategy because they think it's utterly obvious it will make them greater returns, and this is why it doesn't.